move on to our next and the first session of the day now. From 2010 to 2023, the financial inclusion sector in India stood out for its high investment growth, raising close to a total of $12 billion. While other sectors such as climate tech and technology for development have gradually made up a proportion of investments, financial inclusion continues to stand strong, contributing close to 30% of the investments in 2023. This session aims to provide a comprehensive overview of the evolution of financial inclusion in India, highlighting the progress made, challenges faced, and future prospects. Our panel of specialists include Aishwarya Ravi, Chief Financial Officer, Kinara Capital; Ameya Bijul, Partner at Encourage Capital; Rajat Bansal, Director at Lok Capital; Smriti Chandra, Investment Director at Abler Nordic. Last but not the least, the session will be moderated by Mr. Ashish Sutar, VP and Principal at Desai and Associates. Over to you, Ashish.
Hi, good afternoon. I'm Ashish from Desai and Associates. So glad to be here. Not the best time for the session, post lunch, so I'll try and be as engaging as possible. We have a collective experience of more than 80 years of investments on the panel right next to me. So I will just request all of you to probably just introduce yourself, just speak about the work that you are doing, then we kind of take it from there.
Yeah, please. Hi everyone, I'm Ameya Bijul, Partner at Encourage Capital. We've been investing in India for the past 15 years, primarily in the financial sector. So as we'll talk about today, across a range of themes, microfinance, MSE finance, housing finance, even financial market infrastructure. And our focus now is about how these themes really enable climate outcomes.
Hi everyone, good afternoon. I'm Smriti Chandra. I represent Abler Nordic. We are a Norway-based financial inclusion fund focused on investing in financial services across developing markets, which include Southeast Asia, South Asia, and Sub-Saharan Africa.
Hi, my name is Rajat Bansal. I'm with a firm called Lok Capital. We started off as a financial inclusion focused firm, and over time we diversified into sectors like food and agri, healthcare, and more recently started into the climate. We make equity investments in India as well.
Hi everyone, I'm Aishwarya Ravi. I'm the CFO of Kinara Capital. Kinara has a long history, comes from pre-investment, and what we do is try to give you the missing level wherein traditional access to finance is denied to this population, and we give business loans, business credit to these populations. And we've grown to fund more than 50,000 customers as of today, and our portfolios has 50,000 crores.
Super, fantastic. Going back 20 years, I think India's journey of financial inclusion has been quite an interesting one, almost defying all odds as to where we have reached till now. And I think the framework that we are looking at least for this discussion, is just trying to understand the journey of financial inclusion from the lens of institutions, people, business models, products, service delivery, technology, and regulatory and legal requirements as well. And with segments across, say, banking, payments, insurance, lending, and wealth management. And just to put things into context, let me just throw some numbers at you. I was just checking the RBI data last night for preparing for this session. We have somewhere about 500 million people having bank accounts in India. The CASA deposits are somewhere to the tune of 2.5 trillion USD. Total payments as of FY24 were somewhere about USD 30 trillion. We have a $1.98 trillion loan outstanding amount. We have 160 around 71 million demat accounts, and the total insurance premium volume is somewhere about 150 million. This is annual, and this has been an exceptional journey. I mean, these numbers are staggering and almost growing at 15-18% year on year over the past couple of years, irrespective of how COVID kind of impacted as well. But there's still a long way to go. I think there is a missing middle segment right over there, the USD2 to USD8 per day. That's somewhere between 3 lakh to 8 lakh annual income. We have 72% of all loans in India are still under 2 lakh rupees. If you churn the Mudra lending data, you'll find that 75%, 74% of them are under 50,000, and only 20% of them are between 50,000 and 5 lakhs. So there is a huge potential for kind of scaling some of these lending initiatives over there as well. So the course of the next 40-45 minutes, we'll kind of look as to what worked, what is working now, and what will be. So I think to begin with, I think we'll start with Smriti, given the Nordics experience in investing in microfinance and financial institutions and geographies. I think if you can just help us understand what are the unique factors that help the Indian financial inclusion journey being slightly different, or slightly more in depth of with respect to say other geographies. We'll start from a huge 30,000 feet view outside in perspective and in the central markets.
Yeah, I think what happens is when you have a portfolio across different geographies, you have the luxury of comparison. And in our case, India dominates as a large portfolio. 35% of our assets are invested in India, but we do have 65% invested across Africa and Southeast Asia. And clearly, if I have to call out today which is the portfolio which is performing for us, it comes back to India. And there are a few factors for that. And the main thing is the kind of scale that we can achieve in India is phenomenal, which we don't get to see in majority of the other countries, barring maybe Indonesia to some extent. Other than that, the kind of growth and scale that we see in India, absolutely. The second thing that I see is also worked from a financial services space is regulatory maturity of some sort, which we don't see in many other countries. We're always scared of what RBI will do, and that's a good thing, especially when we have a huge credit risk to think about. So that's always been helpful. I know institutions fear it, they don't want to get involved, but I think as a sector, if we have been able to reach the kind of scale that we have today, RBI has a big role to play in that, and the guidelines have a big role to play. And of course, the last one, which I think has really helped and differentiates us, is the JAM Trinity. That's really taken the scale to a different level. And the fact that we have common credit bureaus, for example, as simple as that, although there is a lot of lacuna in terms of how data gets captured and unique IDs, are they relevant, not relevant, but irrespective, we are still able to look at customers' history in some format, which we don't see again in most of the countries outside of India. So I think a combination of these factors have really stood out for the financial inclusion sector to enable access, to enable reach over the last decade, if I can summarize on that.
And Amaya, you've been involved for almost 2 decades now in the financial inclusion investment space. And your investments include, I did make a note, so Electronica Finance, Annapurna, DCB, NSC, Ujjivan, some of them are listed companies now as well. So what have been like key milestones that you have seen over the past 2 decades from a financial inclusion journey perspective, and what role does a asset management firm like yours play in this system?
No, thank you for that. I think for us at the outset, financial inclusion was about a broad-based approach, right? So when we built our portfolio going back to 2011, it was to make sure we touched various segments of the market. So we invested in microfinance shortly after the Asian crisis. We did that on the back of a strong regulatory framework that really underpins all of the work that we do. We looked at MSME finance also. This is no problem that had been widely researched, but still remains a big challenge. Housing finance, and then of course the financial market infrastructure that to all of us. So I think in terms of milestones, I think Anurag laid it out. Hard to follow Anurag after that, but there's been a lot of progress. But I think there is a tremendous amount of work that's left to do, which gives all of us a lot of excitement. I think a lot of opportunity. When I think about the milestones, you mentioned some of the listed companies. I was just looking back. We track a financial inclusion peer set now, right? Where we are evaluating companies on a new investment, on an ongoing basis. It's 25, 30 companies that form that peer set for us. I think when we started in 2011, we would have had a couple people in there, right? So that shows that these businesses have gotten to scale. They've attracted new forms of capital to the public, and I think they've also created opportunities for talent. One of the things that we get very excited about in the financial sector is the quality of talent that the sector attracts. Right? I'll show an example of that, and we'll talk about that. But that is one where we get excited about how this talent can capitalize on the opportunities. And employee stock option programs and other things that we make sure are a key part of our own thesis, we'll see some of the rewards of that, making sure that gets transferred to the employees that create value. In terms of where we're headed as an asset manager, for us it's been about the why. Why are we doing this? And what are the outcomes that we want to enable? I think when we think about an inclusive financial system, and if you were to link it back to sustainable development goals, 13 of the 17 are enabled by an inclusive financial system. For us, as Adam talked about earlier, climate is an area that we care a lot about. It is the need of the hour. And so the climate transition for underserved segments won't happen without an inclusive financial system. We'll talk a little bit about this later in the session, but the promise of low carbon technologies is a higher upfront cost for the lower running costs, or lower cost over time. That is a financing opportunity. So we help financial institutions provide those services.
This is super helpful, especially on the talent bit. It's an underrated topic that we do not focus on. I was just discussing this with the panel earlier as well. About 80,000 people attended the Global FinTech Festival last 2 weeks ago in Bombay. I mean, it's a thing now. We're just talking about the fact that there's a Global FinTech Festival happening in India almost every year with a 50,000 plus team. And earlier banking was not well looked after, like it's a slow job. Now people are scrambling over each other, just trying to get into the banking space. So I'll turn to Aishwarya. I think you have seen the evolution of Kinara Capital, primarily serving MSMEs, and the kind of challenges that we have seen over, say, pre-COVID era, the COVID era, the digital transformation, and so what have been, like, what did not work, what enabled you to pivot, and what enabled the success of Kinara Capital to what it is.
So our journey is actually closely aligned with the evolution of this market in itself. And if you look at the journey of financial inclusion, unsecured MSMEs are one of the most excluded segments talked about it in current statistics. And this was true even in 2011. And by exclusion of them, traditional financial channels do not give access to these customers, these businesses, because they don't have an under-covered platform. And that was the fundamental USP which Prabhav started way back in 2011. And the thesis was simple: how do we include solid businesses at the lower, small-term, mid or micro segment of business who have the potential, who have the business, who have the ability, just didn't have land or property collateral, and still have a proposition for them which will work both for the company and the business. And that sort of stayed true to form through all of these years. I know COVID happened, and I know we've been fortunate or unfortunate to be in India, where every year is a black shiny event. I don't know where to start, but we started with GST, demonetization, GST, and manufacturers, go way one, way two, and it almost is testament to the fact that the MSMEs have been resilient through all of this, and so has the segment of financial inclusion in India, which shows that as an emerging market, even though there are economic shocks, ecosystem shocks, we've been able to manage this through good, solid fundamentals in business model. Now, coming to specifically what challenges we face, identifying these business enterprises was itself a challenge, because if you look at the MSME population, currently about 65 million enterprises are out there, but most of them are still unregistered. Hardly about 20-40% are registered in any traditional form. And if you need to underwrite all of these business borrowers, it's another ballgame altogether because you don't have access to information in a clean form. They will have multiple ways in which they do business, which needs to be taken into account to have any meaningful impact in terms of what funding we can give them. So assessment was a big sort of challenge in terms of how we think about it. And the third was actually talent. Now, how do you bring in talent who first of all believed in this business model and understood it and pivoted in terms of how we need to underwrite this model and still have that enablement to these sort of customers. So all of this put together, the final challenge was last mile distribution. These borrowers, these customers were distributed across different geographies, and every single customer was different because they come from different backgrounds, different segments, different sectors, and you don't have a nice happy little margin which you can use and say that this is what your financial sector. All of this put together was a good problem to solve, which will enable financial inclusion, and that was sort of the driving thought behind building this book to 3,000 crores today. It's been fascinating, and every day is a new.
And Rajat, I think from your perspective, you have been again investing in financial institutions across various segments, and you've also seen an evolution from the investor perspective. So what have been like the key, say, the policies and market dynamics that enable that rapid growth across four levels? I think I remember first fund was the microfinance side of things, moving to second fund, which was earlier microfinance, then became SFBs, then the third and fourth where slowly it was more technical side of investments as well. So if you can talk about the market dynamics, the policy, the regulatory environment, and all of those things that kind of what you till date in terms of the work with low capital as well.
So to a large extent, I actually echo what Smriti also spoke about, both from a regulatory perspective as well as the JAM kind of trio that came in to enable a lot of it. I'd probably pick up Ashir on one of the things you highlighted more initially about the middle income or the middle market which is not getting served. I think largely the focus over the last few years has been there. And I think the two areas where we've seen the most progress coming there, one is the credit bureau system, which Smriti also touched upon. Having the data for the last 7-8 years, including for microfinance customer, including the better penetration of that system in the end customer segment, really enabled the suppliers to go and target that segment. So for the longest time, people have tried to underwrite individuals rather than groups and not done a very good job of it. And I think that fundamentally the customer hasn't changed. It was the inability of the supplier to make sense of that customer which was the issue. Increasingly we are seeing that is getting solved to a large extent by bureau data being available and there having been enough cycles of credit that customers have come through. Second, purely with the overall digital penetration, if you look at the sheer awareness that the customer has today, and some customers use it for the wrong means as well, but we hear very interesting stories of customers applying to the bureau on the same day to make sure that their bureau doesn't show a hit for any of the other vendors. But overall, in a large part, the customers have actually become so much more aware that they are demanding the right kind of services. So what used to be seen as early days of microfinance is probably a welfare or a development activity, almost like a top-down approach where you're helping uplift, quote-unquote, a customer segment. Today, that's a very viable customer segment that's demanding service, that's demanding products, where you have to meet their requirements or they have 3 other providers at their door for providing that service. I think that's probably the biggest change that we have seen. And probably also the most fulfilling aspect of financial inclusion over the years when we go to customers compared to, I started working in 2010. Compared to then when I go now, the customer is a lot more demanding, right? And they're not deferential to you because you've come from, for them it's all head office, right? So you've come from the head office of the company. They don't care. Right? This is what your staff said to me. This is the problem with your product. Other guy lets me repay, once a month. All of those things are a very normal conversation now. And I think that's probably the biggest change which has been enabled by some of the factors we spoke about.
Just to, I think, double down on that as well, if you can just also help understand, say, what has been, the business model shifts that we have seen in enabling some of these financial inclusion, products and journeys. I think from the perspective that operating costs have reduced over a period of time, but there is also systemic risk in terms of high cost of capital for financial service providers. Insurance is a separate ballgame in itself, with almost the lowest penetration as of now, 7% of total GDP in India. So I think with that lens of, say, business models, product and service delivery, what has been your experience in the models that worked and on a very large scale? I think the key fact over there is we're still talking about like 650 million plus customers at any given point of time that are going through this financial system. So if you can just double down on that.
So I think probably best to look at it as a journey. Credit is obviously probably the most needed in a way, and if I think about last 10-15 years, to a large extent that market is pretty well covered. There's still a lot of ground to cover, but as Anurag was talking about the microfinance industry growth, the numbers are there for everyone to see. Payments purely as public infrastructure, making sure when you have digital means of payment, you have networks where you can walk into a CSP, deposit your cash, all of that is well covered. I think from a overall product perspective, it's the insurance and savings piece that needs solving. And increasingly we're seeing a lot of very interesting models come up there. And to a large extent, the problem statement has changed. So the way someone would have tried to distribute insurance to rural India 10 years back versus how you can do it now is completely wrong. A company would have tried to create their own distribution for rural India, either hire people or appoint agents or go down that path. Today we see insurtech companies customizing products, riding on existing distribution of, let's say, financial services companies, MFIs. Everyone has built distribution in deep rural parts of India. Can you just ride onto it, tack on your product, customize it to meet the needs of that customer, and let that be the product that gets delivered instead of replicating the effort to build that distribution? I think that's probably where the problem statement has moved to today. And something similar happened in the savings space as well. So over the years, we've tried to back innovative models. We backed a multi-product, deep rural financial services company 2011. Mixed results. It's not easy to sell savings or investments to a deep rural customer. We backed a purely healthcare savings product company, which was an idea when we came in, tried to build it up. Again, very difficult. Behaviorally to drive savings as a product it takes a very different skill set for the customers. So probably a model whose time hasn't yet come. We backed the insurance distribution play on the agent-led side. So we made those attempts, but end of the day, we are also a bit of a hard-nosed commercial investor. So if it's not making commercial sense, then they're not going to put in too much capital in that idea. So we keep seeding some of these things and we see how it plays out. And I think as the market dynamics change, a lot of these models will start becoming backable, scalable. We'll start seeing more exits in the non-credit space in financial institutions.
Just building on that, Aishwarya, I think with Kirana's focus on MSME lending, I think the host of products and services that you have, and very interestingly, I was checking your end, the work that you are doing is across short-term, long-term working capital, machine, loans against property, machines. Very interestingly, also to bill discounting. And what you also do is building the capacities on the supply, on the demand side, in generating value for MSMEs to know why credit is important, and then bringing them into the fold. So I think if you can just help us understand what has Kinara, the innovation that you have brought down to the market in terms of both on the supply side as well as the demand side, in building the investment readiness of the customers, then giving them the customization of products and services, the way Rajat mentioned, and then taking it to the last mile service delivery to the thing. You have, I think, more than 100 cities and in which you're operating. So yeah.
Sure. So, why these products? It was a function of what our target segment was. Very clearly, we were core to our target segments of the micro and small scale medium enterprises. And basically, what they wanted was what revolutionized what our products are here today. And to give a bit of a background, we actually started predominantly with asset purchase all the way back. And by asset purchase, I mean machinery purchase and not loan against property, because we were very clearly an unsecured player, but still we were okay to fund used machinery and new machinery of sorts. And that's how the model started initially. But quickly we realized that there was more demand in the working capital side of things, because that's where the small and medium scale enterprises needed that gap, that working capital gap, to be funded, which the traditional channels today did not fund, and enable them to elongate their cycles. And this was sort of very important. So that's how we started our working capital product, our asset purchase product. And then what happened was quickly COVID came, some more working capital came in, so there was a sort of pause there. But post-COVID, what suddenly happened was there was a lot of orders going on in the market. There was a lot of supply differentials which was coming in, and the volume started seeing a significant increase, and real discounting between the need of the hour at that point of time, wherein on both sides, on the supply and demand side, there was a sufficient demand in terms of credit availability for this particular segment to build discounting products, and we sort of financed that as well. And it was truly what a bouquet of products which would cater to the need of our customers, and that's how all of these were put into place. We also tried a couple of different products along with normal loan products in terms to understand what the customer really wants, like insurance, whether he or she was needing an insurance. We tried a little bit of Medicare, because the health of the entrepreneur, in our case 92% of them were entrepreneurs, which means the sole proprietor was the most important person for that business. Any medical help or Medicare facility for the business entrepreneur along with his family, would that help in enabling them to do better? So a lot of such smallish products was something we tried to work with all of these business entrepreneurs. And beyond that, we also tried to work with them to make them understand exactly how to run their business as well. Because at this level, they were good at regular to-dos, but if given the right support and education and knowledge, what we found was they could grow their business to the next level. And we have these series called Grow with Kinara series, where we talk about all the products which is available, what they could do for the business, how they could improve their business to the next level, and across different tax schemes, investment schemes, running of the business lifecycle schemes, we used these workshops to enable the customers to understand what are the available products. Rajat mentioned in terms of the digital art, that is significantly come into effect now. Like after COVID, we've seen a sharp increase in terms of the understanding of these customers and the demand what they need in terms of how they want their products to be. So there are embedded supply chain products today, which I think even a few years earlier, the kind of customers we deal with could not have engaged or understood these products. But today, they are very adept in handling all of these and through apps from their phones. And that has enabled this process to be faster and smoother. And I think a lot of different new models will come up shortly in this space, because even the customers are now iterating as to how or what more they can do with different players in the market available for them to be serviced.
Really helpful. And Smriti, just over to you as well. I think with the aim of building sustainable institutions that serve the underserved communities. How have you kind of thought about the challenge of impact and profitability of the investments that you're also looking at? There's a very delicate balance, and BFSI across the board has, I think, one of the most razor thin margins of sorts, especially on the banking side of things as well. So I think just understanding how is it that you look at the BFSI space, the financial inclusion space, when you're balancing impact, profitability, and taking that in terms of also the systemic risk that exists in the market, the market volatility, so so even high cost of capital across the board, the ECB or the Fed Reserve, the RBI still having a regulative, within odd times to live in where it's the highest interest rate that we also see. So the currency risk and everything is also a continuum for the last 5-6 years. So how do you kind of manage these two from a risk management perspective as well?
Tough one. Because it's always tricky to measure returns in whatever form and format, right? But the way we kind of look at it is that internally, when we look at the returns at the fund level, there is equal importance provided to what we call as social impact and the financial impact. Under social impact, the earlier narrative used to be financial access. That is where we started off with 10-15 years ago. There, slowly we are seeing that the language that we talk today is no more just access, it's about building financial resilience to the families, to the households that we service. And how measurement is also evolving along with this is a journey by itself. So that's one aspect of measuring impact, measuring returns for us. And the other half is financial returns. Now there, what we believe is that the business model and the unit economics should be such that the institutions should sustain themselves. Are we expecting hyper growth and hyper returns? Especially for our fund, I would say no. Our endeavor is that the institutions build sustainable businesses themselves and are not always dependent on aid capital or any form of concession capital to run the business. Does that mean that we don't expect any returns? No. So I think we fall somewhere in between. As long as the institutions can sustain themselves and we are able to return our money to the LPs with the reasonable returns, that's fine. So we get measured on both aspects, on social performance as well as financial performance. And the way we kind of look at mitigating different risks that come across is that can we diversify our portfolio in any sense? Whether if it is within India, then different states, different products. If it is across 3 different geographies, then that's one level of diversification. So at the fund level, we are still able to maintain a reasonable returns that we get. On currency, for example, we have an additional facility that we get as a support from the Norwegian government. So that kind of allows us to provide loans in local currencies and take that shock, if at all. So there are various ways we try and mitigate and ring fence ourselves from the risk that exists. But we are also very aware that being an equity investor, there's always risk. Right? Vis-a-vis a debt where at least the probability of the money coming back to you as a lot more versus us as an equity investor. And that's really the bet we take on the institutions and the team which is running the institutions. So yeah, it's balanced return concept for us. And so far with the 4 funds, we've been able to manage it reasonably okay, I would say.
Super. And Amira, I think while you were introducing yourself as well as speaking in the first, you mentioned that clean energy, climate action is something that we're looking at, and there is a strong overlap with, say, the prevalence of climate action initiatives and financial inclusion. So you can touch upon how are these two sectors intersecting, and how is it particularly relevant for underserved populations? And in the last 2 editions of the Southern Conference that I know if you have attended, I think in last edition, I think Sri Jayansen had come down saying microfinance institutions have the largest role to play in enabling climate action to the underserved, and especially the 50,000 ticket size of lending. A lot of very interesting things that they can get into the electric bookstores or the two-wheeler, three-wheeler electric vehicles and stuff. So how does that how do these two sectors kind of intersect, and how do you look at this space evolving?
Yeah, sure. As I said earlier, I think a lot of the climate solutions that we're talking about, right, have a much higher upfront cost than a lower cost. So that is what creates that finance. I think just touching on what Rajat talked about, customers are fairly set, right? Incredibly set, and the competitive landscape is increased. Right? And so, as Ashwarya talked about, lending institutions are looking for differentiation. They're looking for new products. And so, in our view, the climate opportunity is one which is completely untouched, right, from this customer segment. So, we focus on the MSME customers, and for them, rooftop solar is the area of focus for us. So, rooftop solar can be incredibly economical for these customers, but the upfront cost is significant. So, we approach this market with a significant amount of research, going into industrial clusters around the country, understanding the needs of these customers from an energy perspective, finance perspective. And it was clear to us that without financing this market, this was a 15 to 20 gigawatt market. Right? So, we felt that if we could work with existing institutions that understand these customers, have the distribution, have the credit experience, and have the capability to introduce new products, we can start getting solar finance into these customers. Now, as a growth equity investor, it's not just equity capital that's going to help you make right? It's a set of tools that will help these institutions build these specialists. So they understand the customers, but the solar or climate is limited. So through one of our investors, we have a capacity where we can run projects at the portfolio company level for product development, market development, training, we build technology tools. We do these things that not only help launch a solar product, but support the business overall. Then we also bring in tools, risk mitigation tools from groups like USDFC, and that helps these institutions de-risk. So what that does is, there's oftentimes in launching a new product, there's a gap between what the actual risk is and what we see. We don't know. And so, in our experience, these tools can help institutions prepare to launch the products and then also de-risk. So far, we've done over 1,700 MSME loans, about 84 megawatts or so. The default rates have been incredibly low. They've been lower than any other lending that we've done to these institutions. So we feel that we're building a set of pioneers in climate finance. And what's fascinating is ultimately we are backing entrepreneurs, right? So we get them going in that particular area, but their own initiative picks up from you. So you're backing microfinance company, who is probably at the South Conference, right? And if we're not, right? They started the journey on rooftop solar finance. They approached us and said, we want to get into electric vehicles, we want to get into hybrid cars. So we can bring a set of tools that help them get into those segments, but it's their initiative, right? And so they have a vision of building a 100-person finance team. So now we are keeping pace with their ambition. And so for us, there's so much to do in this space, and it's really exciting to work with financial institutions.
Just moving towards the last segment, so short of time. I think was closing the whole discussion. I think starting with Rajat, if you can, I want the consistent 2-3 things that even Sandeep Faria said in the intro, in the panel, and even Adam mentioned afterwards. There's a need for systems approach towards financial inclusion and in the investing space. And there's a lot already being done in terms of financial inclusion as well. Across the segments, a lot has already happened. I mean, the numbers that I started off with, we're at a staggeringly high growth rate as well, and there's a lot of domestic consumption that's already happening. What are the new frontiers where you believe that investments in the financial inclusion space is going to happen? Be it the fintech space, be it the insurance space, be it on different things within the framework of financial inclusion. Where do you believe is the next frontier, and with LPs and GPs sitting over here, where do you think that the money needs to be directed towards supporting that journey in the next level?
On the question of frontiers, I'd much rather have founders show us the frontiers. I think we are by nature risk averse. We will like to measure risk, is there enough return? We're not the right people for defining frontiers. Founders who come up with ideas, push the limits, actually try to create something. I think they have a vision. They take the risk and we just go along for the ride. Like Amaya said, we help a little bit, we have facilities, we try to support the best we can. But if I just think about what are probably a wish list, what are some things that you would like to do or see as an industry, in areas where there has already been enough penetration, say credit, some of the numbers that you spoke about. Probably the discussion now needs to also move on to quality, not just quantity. So are you doing it the right way? Are you keeping the customer's interest in mind? If it's a bank depositor whose funds are ultimately becoming credit, are you doing right by that depositor or that investor? I think it has to become a lot more qualitative in addition to measuring what kind of credit growth has happened. In other areas, if it's insurance, if it's savings, I think there it's still a numbers game that we need to solve first. It's still the penetration, it's having the right products, it's having the avenues for people to invest, for people to be protected, assets to be protected. That needs to ultimately be achieved, and along with that, quality will come into the conversation. So that's probably, it's almost like a quadrant in my mind where things that have gained a sufficient scale start thinking about making it better, not just bigger. And things where you still need scale, just go all guns blazing on solving for the core problem, trying to get to the right customers. And along the way, you'll start talking about quality and overall level of services.
Super. No, this actually is close to home. As they say, associates, we are also working on figuring out how do we build blended finance and outcome-based financing solutions and either opening financing to new markets or de-risking existing commercial investments, or finding appropriately priced financing mechanisms for MSMEs and retail customers to access credit and other financial products, or even just make investments a little more outcome focused, a little more impact focused, where you are measuring certain things, be it say amount of megawatts of solar rooftop energy being generated or water saved through wastewater management. Aishwarya, I think looking at the developments that have happened, what are the new frontiers in, as a banker that you are kind of thinking around and preparing the organization? I think there is an urgent need for even financial organizations to be resilient enough to withstand these shocks. And so how are you working towards getting these new developments, be it AI, be it the tech developments, and there's a very interesting thing. SATSure and partner with TransUnion Civil on figuring out climate as a risk parameter for credit ratings of MSMEs, and especially academic-based MSMEs. So I think just having those kind of new developments coming in, how are you preparing the organization, and how are you looking at this space going forward?
It's a super broad spectrum because all of us are preparing nothing for that, and there are like million things for that. But I would maybe restrict it to three main buckets, at least in the context of what you asked. The first bucket would be around technology and product innovation in itself, and I think that's very important. On this side of the table, we need to continuously reinvent as to what the customer wants today and how do we service the customer best. And by that I mean, in today's world, turnaround time matters. The ability to fund that customer with all of the information and yet fund that customer immediately is a huge important driver for business to grow. And the Reason token platform and the account aggregators platform will go a long way in helping us do that. So technological advancements in such areas will help And we need to be prepared to adapt to it and not stick to our own methodology, and that's very crucial. So now mindset, product innovation, along with where the industry is moving, like AI, it's disrupted the entire journeys, and we talk AI in different versions, but how do we use it creatively in even our efficiency forces around operations, how we build it back into our normal day-to-day business is very important, because if you do not disrupt it today, somebody else will do it, and hence the business model might come into question. So I think it's a very important bucket from our point of view. The second bucket is the regulatory bucket. You mentioned at the start of the conversation on RBI being the warrior who takes care and ensures that everybody goes the line, but it also comes with the cost to the operational side of things. While they are one of the best in terms of framing all of the regulations around, one of the best in terms of the world class itself, the rate at which the innovations are happening are also pushing them to create a lot of rules and regulations, which again comes with the back end tail bite for an organization, and that's something which we need to continuously reinvent and ensure that we are on point, so that we are not on the wrong side of things. And the third and last bucket in my mind would be on capital, actually. Capital enablement, and what we are seeing increasingly is access to capital through different avenues, under the green, orange bonds, wash portfolio, and all of these are very closely aligned with our customer segment, but as Anna was saying, convincing them that it's an upfront cost which will yield them result over a point of time is, I think, the biggest factor which is important as we try and sell these products, which comes up in terms of our learnings in this market. But we are happy that we've been able to raise differentiated financing through orange bonds, MIF, and responsibility, green bonds to responsibility, etc., which goes a long way in showing that there's a lot of appetite in these portfolios. If we could find channels to route this money into the intended borrower segment. So I think that's very important in the coming years to figure this out, so that as an ecosystem we can be more ESG positive.
Super. Smriti, from your perspective, I think the question that needs to be asked is there anything that India can import in terms of either policies or other interesting developments that are happening in other emerging markets to accelerate the journey of financial inclusion? A lot of people also do say the fact that India is leading that entire thing. So mixed perspectives. So wanted to hear how is it that that space will evolve, and also the fact that what can be done to get more people like you and companies and firms like yours to join in into investing more into India and accelerating the journey of financial inclusion.
Yeah, you're absolutely right. I think if you look at the developing markets, developing world, and in financial inclusion, India definitely leads. I think a lot of the other countries draw inspiration from what India is doing and try and adapt it and customize it for themselves. So there's not really that comes to my immediate focus that I can pick and use it in India, which is not tested in India in some form or format. But a couple of things which does stand out in comparison is, one is in Africa we've seen mobile first models evolve. They've had their share of grief, but I think there is something which we can look at bringing in, where companies are integrating to mobile first models in servicing the customer segment, which we are still not able to reach. Especially, if you talk about the underserved segment still being large, right? And if you actually see number of families which are less than 5 lakh income today, that's about 200 million, right? And in that we have 60 million which is less than 1.5 lakhs. So what are the products? And none of the institutions today, I wouldn't say none, but most of the institutions today are not really targeting that segment. They're all still trying to address the top of the 200 million today. So are there models that have got scale in Africa which we can look at adapting here? Is something which I would probably want to explore. And the second thing which I've also seen is that we do have an option of taking deposits. Like NBFCs, you can be a deposit taking NBFC here to get down your cost of fund, but not many are using that as an option, right? Because it comes at a certain scale, it's a lot of regulatory compliance to be followed. But if I look at developing markets, being a deposit taking institution, NBFC is very, very common. And the cost of capital then comes down significantly. So that's another aspect which, in comparison, I feel we can do something in terms of bringing down the cost of funding for our own NBFCs in the space. But if I move away from the developing world and look at the Western world, more developed segment, what can we do better? Two things that strike to me. One is that while RBI comes up with a lot of guidelines, processes to be in compliance, etc., there's always a loophole. Right? There is never clear-cut guidelines. You can always play around with it. So there's a lot more we can do in streamlining guidelines that are applicable to the institutions where there is no ambiguity in doing business. And the second one, to attract more and more capital, I think all said and done, the ease of doing business is still not there. There are a plethora of registrations required to run an operationally heavy business. So is there something we can do to streamline that a lot more, make it easier for institutions to come and invest here? Are the two areas I feel we can learn something from Western world.
Yeah, absolutely. And interestingly, when you were speaking about the rooftop solar part or even the kind of thing, when we were looking at RBI's reported data that happens every quarter, even today, it's agriculture, it's industry, services, it's trade, it's personal finance, it's retail, but there's no special mention of planning per se. And I think we need somewhere about $165 billion per annum to solve this the net zero development plan till 2070. The government numbers in terms of achieving it. So where do you see now, as Encourage Capital itself, how do you see scaling your work into India and moving and going in depth, be it the climate space, be it the financial inclusion space, and the intersection of both? How do you see that emerging in the next decade or so?
I think this is the opportunity for these days, right? In our own estimates, we think that there's a $100 billion for climate infrastructure segments. So, I think a lot of the work that we tend to see in the research around climate tends to be about climate risks, which are incredibly valid, which will impact how we sector example like you mentioned, but there's a whole other bucket of climate opportunities that. So for us as a smaller manager, it's about proving out these buckets, right? It's about doing the direct impact that leads to the systemic impact. So if I look at where we were in rooftop solar when we started our journey, there was nobody like it, just a couple of companies. And Top Power, one of the largest EPCs in the space, put out a report in February that said that 20 plus lenders that were fantastic. We still haven't scratched the surface. Right? So, our goal as an institution is to help mainstream. So starting with rooftop solar, there are, thankfully for the entrepreneurs out there, there are many other innovations and areas that they're working on, and that'll just increase the set of solutions. So, it is early days in terms of the basket of solutions, but many of these are cost effective right now, and it's one where we can finance the data with some of
Just to the close of the session, are there any questions that from the panelists that you have? Just take a quick round and then we close it. No questions. Okay, we can close the panel, and thank you so much for the panelists for insights. Pleasure speaking to you and getting the insights as well. And collectively, the kind of insights that we have given charts a very hopeful and promising future of financial inclusion in India. So thank you so much for that.